Good morning, good afternoon, wherever you are. It's Jordan Dove on January 30th, 2023. Excuse the hair. I'm going to get a haircut after this video, and I did not want to have her wash it, even though it feels great. But hey, the Rebels beat Reno on Saturday. We were at the game. It was a great time. Remember Reno in Las Vegas? This is our state. So how about them running Rebels? Turning it around a little bit. Hopefully we can make a run going into the Mountain West Conference tournament. But as always on Monday, we are going to talk about our economic and national housing market update to keep you guys informed. So when this video is over, you are going to know more about the housing and economic market than 90% of your peers and colleagues and families and friends. So I hope this video suits you. Please like and subscribe to this video and subscribe to the channel if you have not already, and hit that bell notification. We're going to get right into it. All right, so let's get into it today. This is the market pulse for the week of January 30th, 2022. And we're going to start off with our little quote: strive not to be a success, but rather to be a value. And that was said by Albert Einstein. So if you guys do not get this email, go ahead and leave your email address in the comments, or go to jordandove.com, click subscribe, or go to the Substack. All the links are in the description. You can get this in email form. So let's get into last week's review, where the markets rallied. We had losses the prior week, but traders put their rally caps back on and sent all three of the major indexes up strongly on signs that the Fed is going to start curbing inflation without a big boost in unemployment, which is really interesting. We're going to keep our eyes on that. The PCE price index, which is the Fed's favorite tool to look at, it showed that inflation moderated from November's 5.5% read to 5% in December. Meanwhile, initial jobless claims fell by 6,000 to 186,000. In addition, with GDP, the economy grew at a 2.9% annual rate in quarter four. There was some strong corporate company results, quarterly results, and durable goods orders, and the University of Michigan consumer sentiment came in better than expected. And last week it was the Dow Jones that was up 1.8%, the S&P 500 up 2.5%, and the NASDAQ up 4.3%. Bond prices ended flat overall, but the UMBS 5.5% rose 5 cents to $101.16. And Freddie Mac's primary mortgage market survey showed that the national average 30-year fixed mortgage rate continued to trend down. We're sitting in the low to low mid sixes, about 6 1/8, 6 3/8, somewhere in that range, depending on your credit and qualifications. Now let's get into our national housing market update. Then we're going to go into some economic notes, because I'm going in the same format as the email today. Good news for new home sales. They headed up 2.3% in December, although they're still down from a year ago, but the recent trend has been positive. And nationally, sales activity has been rising for the past 3 months in a row. In December 2022, we're at a seasonally adjusted annual rate of 616,000, according to estimates released jointly today by the U.S. Census Bureau and the Department of Housing and Urban Development. That is 2.3% above the revised November rate of 602,000, but it's 26.6% below the December 2021 estimate of 839. An estimated 644,000 new homes were sold in 2022. That is a 16.4% figure below the 2021 figure of 771. The median sales price of new homes sold in December 2022 was $442,100, with the average sales price of $528,400. We currently have a 9-month supply of new housing inventory. And now keep in mind, guys, these builders are giving incentives and they're buying down rates into the 4s I'm seeing here in our market, and the payments are affordable. They're building that into the price of the home. So for example, the way it works is, if you are going to a builder to buy a new construction and they're offering you an incentive of a 4.5 rate, and that property is for sale for $385,000, let's say $400,000, And that's comparable to the area, but with where the market has headed and shifted, what they're actually doing is they'd be willing to sell that property for 380 or 375, but because you're paying 400 and they're the builder and they own these properties, they're going to just take that 20 grand or 15 grand that's built into the purchase price and use that with their preferred lender and then buy down your rate. So that's how they are doing that. Now, if you're cash and not using those incentives, make sure you get a steep discount on those purchase prices, all right? So anyways, there's some more good news. The supply of completed homes have risen rapidly. This is now a 9 month supply, like I just said, for a national supply, which is a significant increase from the 3.3 month supply early in the pandemic. A pending home sales index saw signed contracts on existing homes that rose for the first time since May, and the NAR observed, and I quote, "Recent declines in rates are clearly helping to stabilize the market." Pending home sales improved for the first time since May, up 2.5% from November. Month over month, contract signings fell in the Northeast and the Midwest, which has remained hot when the West and South was not, in the Southwest, but they climbed in the South and Southwest this time. So we're starting to see it kind of even out here across the country. But pending sales declined in all regions compared to 1 year ago. Now, we are having a realtor mass exodus across the country. There was just a recent article that said active agents in Miami dropped 35% in a year as the market cools. And the report saw that Miami had 4,529 active agents as of the fourth quarter. That was down 2,580 year over year. Now, moreover, Inman is reporting that 250,000 agents nationally could leave the industry in 2023. The National Association of Realtors for the month ending in December 2022, 1,580,971. So I'm really interested to see those numbers for January 31st because as agents, our dues are all due at the beginning of January. It's several $1,000s. It's expensive. So if agents aren't doing deals, and by the way, the average agent in the country does half a deal. So if you're doing one deal a year or no deals, you can't really even afford to become an agent, especially if that's your only source of income. And if you don't do this full time, you're providing an absolute disservice to your clients anyway. So we do need a purge in the industry, and I'm hoping that happens this year so the full-time agents will be able to take over more market share. And I'm really waiting for those numbers on January 31st, not just the national association's numbers, but our local association's number. We have about 21,000 agents, and we really need to get down to like 10 or 12,000. So we'll see. I'll keep you updated on that, and I'll let you know. A little did you know to end this section. New home sales and pending home sales are timelier indicators of where real estate is headed because they're calculated when contracts are signed. So it was good news that both trended up in December. Now, if you wanted to know why the market went so crazy, so hot, so fast, and then cooled down so quickly, I break it all down for you in our Teams report. We spent dozens and dozens of hours researching this. It's absolutely free. We explained to you how the market ran up, what the conditions were, why that happened, and then now in the post-pandemic real estate market, why things have slowed and stalled and cooled down a bit. I want you guys to have that report for free. It explains it all in the Southern Nevada market, all right? So some economic notes for you guys. We have a smaller rate increase by Federal Reserve likely as inflation cools. The America's Central Bank is expected to raise rates by 1/4 point on Wednesday, but the question comes in next as to what's going to happen. What is Fed Chairman Jerome H. Powell? What is he going to say? We already know it's going to be 1/4 point. Everybody knows it's going to be a quarter point rate hike, but what is he going to say in terms of where their focus is and where they're going to emphasize their progress on moving into the future the rest of this year? Earlier on CNBC, they were talking about, okay, a quarter point, and then a pause and possibly a reduction later this year. I know other pundits are saying no reductions in the rate until next year. We may see a mild recession, but we had 2 negative quarters of GDP growth in 2022, followed by 2 quarters of positive growth. So what do you call that? Really strange. And speaking of GDP, it rose 2.9% in the fourth quarter, more than expected, even as recession fears continued to loom. But consumer spending spending, it weakened. That was down from the previous period, but it still technically remained positive. A sharp slide in housing is what helped pull down GDP, while boosts in government spending and private investment aided growth. Jobless claims did fall last week, while durable good orders increased sharply in December, but mainly due to demand for aircraft, which are probably shipping to Ukraine. Key Fed inflation measures eased in December, while consumer spending also declined. Core PCE inflation, which is what the Fed loves to look at, rose 4.4% from 1 year ago, its smallest annual increase since October 2021. Consumer spending, however, dropped 0.2%, pointing that the economy was grinding to a halt as 2022 closed, and personal income increased for 0.2% for the month as expected. Treasury bond yields were pretty much up across the board except the 30-year. You can see the numbers here. 30-year sitting at 3.654. That's down 3.2 basis points from last Monday's reading. The 10-year, the 5-year, and the 2-year are all up fractionally. And the 2-year and 10-year spread is shown here in this chart. It's still inverted at a 71 basis point spread. That's unchanged from last week. So although they rose fractionally, they stayed congruent together, and they just rose together and still stayed at a 71% basis spread. Here's a Southern Nevada market update. Our absorption rate did dip below 19% for the first time since November. Resale inventory continues to decline, and we're having steady sales. There's about 5.15 months of inventory in the Southern Nevada housing market. 6 months is considered an even buyer-seller's market. We told you that there was 9 months of new housing inventory across the United States, so we are shifting back towards a buyer's market. Typically, this absorption rate figure here above 20% indicates a seller's market, meaning homes will sell for more and quicker, and below 15% is considered a buyer's market, where homes will sit on the market longer and sellers are willing to give buyers more concessions and better deals. Median house prices were at the end of the month. Now we're still going to have some closings today and tomorrow. So next Monday we'll have the final numbers for January, but we're looking at an unchanged median price of single-family homes. It was at $420. It went up to $425 with the closings over the last week. That's unchanged from December, which was also $425. Condos and townhomes sneaked up just a bit. Condos up about $3,500 to $215,000 median for January so far, and townhomes up about $4,000, just shy of $324. So we are seeing prices at the lower levels, which we're seeing a lot of market activity. I'm seeing a lot of market activity just due to the fact that interest rates have come down a bit. Buyers that were sitting on the sidelines didn't have to compete. So prices under those median single family, $350 to $400 is really, really rocking right now. And you can see that condos and townhomes are seeing increased activity with those prices increasing. We currently have 8,248 active single-family homes, townhomes, condominiums, high-rises, manufactured homes, and multifamilies available in our market. Rentals did dip significantly, 2.63% week over week, down to 3,587 active rentals on the market. The change in available inventory week over week, we had 79 less active residential resale properties on the market compared to the last read a week ago. That's a decrease of 7.78%. This week's predictions: construction spending, manufacturing, services, jobs, the Fed. December construction spending is expected to come in flat. The ISM manufacturing index is forecast to show contraction, but ISM non-manufacturing may reveal expansion. There should be modest gains in non-farm payrolls, average hourly earnings, and the unemployment rate. We'll also get the Fed's Federal Open Meeting Committee rate decision, projected to be a 0.25% hike on Wednesday. All right, real estate tip of the week. This was a shocking number. I just wanted to share with you guys. Home ownership does build wealth over time. Whether you buy when it's high or whether it's low, always live in that payment and live within your means of the payment. You only lose if you sell your property at a loss. If you're going to stand it long term, historically, real estate has always gone up. So if you're thinking of buying a home this year, be sure to factor in the long-term benefits of home ownership. because it does boost your net worth through equity. And equity is the current value of your home minus what you owe on the loan, and it increases when you pay down your loan over time. And home price appreciation drives up your home value. And on average, nationwide, home prices appreciated by 288.7% over the last 32 years. That means homeowners grow their net worth significantly in the long run. So if you bought in 1991 and you held on, let's look at some of these areas in Nevada where we're at. 295% price appreciation. California, 304% price appreciation. Montana, 553% price appreciation. Florida, 429% price appreciation. Texas, 331%. Maine, 311%. It's just up across the board. Let's look at the Midwest. Illinois, 167%. Iowa, 231%. So historically, real estate always goes up. So if you're in it for the long term, if you're buying rental properties, be in it for the long term, because you can cash out, do a 1031 exchange. Anyways, we would love to represent you when you're looking to buy property, residential or commercial or investments. We're here to help you. Just reach out to me. Let's schedule a consultation. Let's discuss your goals and let's get that moving for you. Watching the Federal Reserve, we are forecasting Federal Reserve policy changes in the coming months. The futures market expects the Fed will vote for a 0.25% rate hike this week and in March, then nothing in May. There's a 99.9% consensus among Wall Street bankster gangsters that the Fed will raise their rate to 4.5 to 4.75%. The current rate is 4.25 to 4.5. There are also an 85.5% consensus on those same Wall Street gangsters of a 0.25 point hike on the May 22nd FOMC meeting with a pause on May 3rd. So we'll keep you guys informed on that. For this week's Market Pulse, go Rebels. I root for Reno when they're not playing the Rebels because it is Nevada. But hey, both teams are having pretty good seasons so far. I think UNR was 15-6 when we beat them. That was a nice win. Anyways, hope everyone's doing great, doing well, staying blessed. I am grateful for you guys being here. I hope you go crush your goals, chase your dreams, don't give up, create wealth. Be healthy, be happy, be at peace with yourself, and make sure that you send someone some love. You guys take care. We'll see you next time.